Hi, welcome back to my channel. It's been almost 2 weeks since the infamous Israel-Iran war started. The world was on edge as the two countries were pounding missiles one after another on each other countries. But this took an entirely different shape when United States entered the war. After 2 decades, United States entered a war in a new country. Its B-2 bombers pounded heavy firework on key Iranian nuclear site. After that, US has brokered a ceasefire between Israel and Iran. Since then, the flurry of missiles have stopped, at least for now, but the situation remains tensed. What this episode means for global economy in the long run is still a matter of debate. But in the near term, financial markets are sending a clear message that the impact of this episode will be minimal. All asset classes have stabilized and they have recovered all the losses they made just after this crisis unfolded. But how did that happen? To understand this in detail, let's take a deep dive into the financial markets reaction to this unfolding crisis. So to start with, let's look at the market which was impacted the most by this crisis, the oil market. If we look at the price movement in the crude oil market, it moved quickly right after the crisis unfolded. After the first day of attack, oil prices climbed up to more than $74 per barrel. In few days, it breached the level of $75 also. But if you look at the crude oil future today for the month of August, which is the expected price traders believe the price of crude oil will be in August, is down significantly. Today, trading near $66 per barrel. This is more than 10% drop from the recent high. This is significant. So the traders are clearly saying that the impact on oil prices will be insignificant. This is really big because oil is the number one commodity about which world was worried about when this crisis began. This was not only because Iran still produces significant amount of oil, but the geographical location of Iran is crucial for the safe supply of oil. And the fear was if the war had escalated beyond anybody's control, it would choke the major supply route of oil for the global economy. Now, oil is always a bad news for inflation. So clearly, everybody started expecting higher inflation in the future. And the bond market reflects this very quickly. If we look at what happened in the 10-year bond market in the United States, the traders started panicking and there was a significant sell off in the bond market. This selling is reflected in yield of the bond, and the yield started rising, touching around 4.45%. But today it has come down significantly. The fear has subsided and the bond yield, which moves opposite to the direction of price, is now hovering around 4.26, means there have been buying in the bond market. Now some people could argue that the reason why yield have come down is because investors are investing in a safe haven, because US 10-year bond is still considered as one of the safest assets globally. But this hypothesis is rejected if you look at the trajectory of dollar. Right after the attack, dollar had started strengthening in value against the bunch of other currencies. This was obvious because the world was moving into United States asset which they always buy in dollar. So when the demand for dollar goes up, its value against other currencies goes up. But since then, dollar value has also come down. After rising to around 99, today it has been trading around 97. So this clearly says dollar is not strengthening once the market has become less nervous about this event. Now, if we ever need to look at the flight to safety, no other asset class is a better indicator than the gold, the ultimate safe haven for last many decades. And similar event has been happening in gold market as well. Just a few days after the crisis erupted, 1 troy ounce of gold was costing more than $3,400. But today it has subsided and the price has fallen by more than $100. Now, this is the biggest indicator that investors are not rushing for safety after this crisis. They have slowly moved on, and now the risk on sentiment is back in the market. They are again looking for risky asset where they can make more return. And if you look at the equity market, the story is clear. It has also bounced back quickly after the initial loss it suffered when the crisis unfolded. Today, S&P 500 is at its all-time high and it has quickly moved beyond the crisis. If we look at what asset classes are telling us, the picture is clear. All asset classes are saying us a same picture that things have improved and we don't need to worry too much about what is happening in the Middle East. This is really surprising because when the war started, we believed that it would cascade into a much bigger event that could put huge pressure on global economy for a long time to come. But all the asset market are saying us that Iran is slowly becoming more insignificant geopolitically as well as economically. Today, its supply of global oil is not as significant as it used to be in the past. Even though it still supplies around 3% of the global oil supply, more than 90% of its export goes to China. At the same time, world is floating in oil as they say. There are many new suppliers and there is no dearth of inventory when it comes to oil in the global economy. In terms of military, the attack by Israel and US has significantly damaged its security infrastructure. Now the appetite for military escalation looks limited from Iran. So the investors are no longer worried about Iran cutting off supply through the Strait of Hormuz or destroying ships carrying oil through the Strait of Hormuz. This strait is significant for global economy as it is one of the most used trade route not only for oil but for many other purposes. As financial market leave behind this crisis, we should still think deeply about what is happening in Middle East. The risk is not totally over yet. It still remains a hotspot of geopolitical tension, and as investors make their portfolio, they should keep a keen eye on what is happening in the Middle East. That's all in this video. Up until next time, take care. Goodbye.